Brian, you've been covering pensions for the last decade or more, and I'm curious what you think about these big funds moving into private equity, the market dislocation we've seen, and now unloading at a little bit of a discount here.
Yeah, I think it was a really interesting move by Calpers. They've, for a long time, been trying to figure out how to navigate their $50 billion in private equity holdings. This is a $440 billion fund, but $50 billion is still quite large in the private equity world, and it's very complex. They're trying to figure out how to get rid of it, and so they took a little bit of a discount, 10%, in order to get out of $6 billion worth. But there's been some funds that have been offloaded on the secondary market at 50% discounts, so they were able to navigate this a little bit pretty well.
Briefly, it seems to be about cutting out the middleman, right, Brian?
Yeah, they're essentially trying to do it themselves. And when you have $440 billion of assets, you can. They don't want to pay the fees that Blackstone or Carlyle charge, for example. So they want to do it themselves. They say, hey, we can invest in private companies. We are a large enough pension. We can do it ourselves.
Brian, 30 seconds. Some delayed until after June 30 to get the key fiscal year behind them. What do you make of that?
Yeah, I mean, it was basically an accounting maneuver, right? They didn't want to have a lot of cash sitting on their balance sheet for an extended period of time, making basically nothing. This effectively allowed them to take some of the cash generated by the investments and continue to put that towards their bottom line.